Good evening and welcome to NewsHour. We begin tonight with a truly significant, even seismic, regulatory shift emanating from Wellington, New Zealand, a pivot that could redefine the nation's economic and industrial landscape for the next generation. New Zealand's parliament has just concluded a marathon legislative session, passing a landmark foreign investment law. This is not merely an adjustment to existing rules, it is a fundamental philosophical overhaul of how the country screens, approves, and actively courts international capital. For years, the South Pacific nation has grappled with the twin challenges of chronic underinvestment in essential infrastructure and a significant productivity slump that has constrained economic growth. The government is now betting that by surgically streamlining decades of bureaucratic hurdles, while simultaneously hardening the defenses against investments deemed detrimental to national interests, they can unlock billions in high-quality, high-value investment. They are targeting highly specialized areas, deep tech, complex logistics hubs, and especially the rapidly expanding renewable energy sector. This legislation is a clear signal to global investors. New Zealand is moving aggressively to compete for capital on the world stage. But what does this game-changing move truly mean for economic sovereignty, for housing prices, and for the average New Zealander? We have the full, detailed breakdown tonight.
Let's get straight to the essential facts and the machinery of this overhaul. The new legislation, officially titled the Foreign Investment for Growth Act, or FIGA, as it's already being called in Wellington's corridors of power, is a direct response to years of scathing criticism. Critics, both domestic and international, labeled New Zealand's previous investment framework as agonizingly slow, opaque, and perhaps worst of all, inherently risk-averse, functioning more as a barrier than a gateway. This framework was viewed as a significant deterrent for sophisticated global firms who require certainty and speed. This dramatic legislative push was championed by the current center-right coalition government, driven primarily by the Prime Minister and the influential Minister of Finance, who framed the act not as a choice, but as an essential necessity for pulling the domestic economy out of its persistent post-pandemic malaise and addressing its widening infrastructure deficit. The core transformative change is the establishment of a robust, tiered approval system. This is where the surgical precision of the new law becomes apparent. Instead of subjecting every foreign proposal to the same lengthy, often arbitrary scrutiny, the system now differentiates based on strategic value. Under FIGA, low-risk yet high-impact investments, those focused specifically on high-tech manufacturing, export-oriented agriculture processing, large-scale clean energy projects such as geothermal and green hydrogen, or major productive asset creation, will see drastically expedited approval timelines. We're talking about review periods potentially slashed from the standard 6 to 9 months down to a hard limit of under 60 days. This speed is the currency the government is using to attract what is often referred to as patient capital, money focused on long-term growth and infrastructure, not short-term speculation. Crucially, the law introduces a mandatory fast-track mechanism. This isn't discretionary. It must be applied to investments deemed by an independent review panel to bring demonstrable, significant, and immediate benefits to the domestic labor market, substantially increase export capability, or provide a critical uplift in specialized R&D capacity. We are talking about clear, quantifiable metrics, not vague promises. The law was passed late this afternoon in Wellington, capping off a surprisingly cohesive period of cross-party negotiation given the sensitivity of the topic. The legislation is expected to be phased in quickly, with the first stage of operational guidelines scheduled for release and implementation starting in the third quarter of this calendar year. Now, why this sudden, dramatic shift?
Officials have made the objective explicit and twofold. First, there is an urgent need to compete more effectively and aggressively with regional neighbors. Australia, Singapore, and even emerging economies like Vietnam have significantly modernized their investment regimes in recent years, leaving New Zealand's rigid framework trailing far behind in the race for global capital. Second, the government is explicitly moving away from overly restrictive, defensive pandemic-era controls. Those controls, initially intended to protect distressed domestic assets from opportunistic buyers during global instability, ultimately had the unintended consequence of stifling legitimate, long-term productive investment even as the economy recovered. The message from Wellington is now unambiguously clear. New Zealand is actively and enthusiastically open for business. but with a critical caveat: only for the right kind of business. It is a calculated risk, trading regulatory caution for economic revitalization. To assess the immediate financial implications, we go now live to our chief business correspondent, Hannah Lee, who has been tracking the initial market reaction from our regional headquarters in Auckland. Hannah, what is the reaction from the NZX 50 and key corporate stakeholders? Live from Auckland, the initial market reaction here in the financial center has been cautiously but decisively optimistic.
We saw a noticeable, though modest, uptick in the New Zealand dollar against the US dollar immediately following the parliamentary announcement, reflecting greater investor confidence in the nation's medium-term economic trajectory. Key sectors that stand to benefit immediately, and whose stocks saw the most movement today, are renewable energy developers, specialized food and beverage manufacturing geared for export, and the growing deep technology sector, centered around biotech and specialized software. The consensus among CEOs we spoke with is that the reduction of processing uncertainty is perhaps more valuable than any tax incentive. Time, they say, is capital, and the previous system wasted too much of it. However, the crucial detail in this law, and what is giving both investors and citizens pause, is the concept of a robust national interest test. While approvals for productive assets are streamlined, any proposal touching critical infrastructure, and here we mean true critical assets like major ports, essential 5G telecommunications networks, or high-capacity power transmission grids, as well as sensitive land, especially coastal and waterfront property, or nationally important media assets, will still face intense, prolonged scrutiny. The government has drawn a thick, clear line in the sand. They are attempting to thread the needle, achieving necessary bureaucratic efficiency without compromising fundamental sovereignty or national security.
This national interest test is not a rubber stamp. It is designed to filter out predatory or strategically problematic investment, particularly concerning state-linked enterprises from non-traditional partners. The next few weeks will be absolutely critical, as the Overseas Investment Office, or OIO, the regulatory body charged with implementing this law, releases the detailed regulatory guidelines defining exactly what measurable criteria constitute high value, and how the national interest test will be enforced without fear or favor. This specificity is what global investors are waiting for before committing truly massive capital. Back to you. Hannah raises a critical point about context and the historical baggage that New Zealand carries regarding foreign ownership. To fully understand the magnitude of this overhaul, we must examine the political and economic environment that necessitated it. For decades, foreign investment has been a highly sensitive, politically charged lightning rod in New Zealand. It often became inextricably linked to highly emotive domestic concerns, namely the rapid escalation of housing prices in major metropolitan areas, and perhaps even more controversially, the corporate ownership of vast tracts of pristine, iconic farmland, often marketed internationally as part of the nation's clean green brand. Successive governments, under intense domestic political pressure, typically favored extreme caution, resulting in a regulatory regime that was consistently rated among the strictest and slowest investment approval frameworks in the entire OECD bloc. The political cost of approving a controversial sale was often deemed higher than the economic cost of rejecting a necessary one. The new law, FIGA, reflects a profound and urgent change in this political calculus. With persistent, stubborn inflation eroding domestic purchasing power, domestic debt levels rising, and a desperate need to upgrade decades-old hospitals, school systems, and rail networks, the government has been forced to confront an uncomfortable economic truth. New Zealand simply cannot generate the necessary capital for major transformative infrastructure projects solely through domestic savings or borrowing. The funding gap is too vast. This legislation signals a pragmatic, necessary pivot. Instead of viewing foreign capital primarily as an existential risk to be mitigated, the government is now actively positioning it as an indispensable tool, a catalyst for rapid economic modernization and infrastructure resilience. The previous system, while successful in protecting certain national assets from quick flips, often ended up locking out the critical capital and specialized expertise needed to improve those very assets. Consider the high-tech sector. Without external venture capital, many brilliant New Zealand startups are forced to relocate to Australia or the US simply to scale their operations. This new framework attempts to perform a sophisticated differentiation, welcoming productive, long-term investment that creates jobs and exports, while continuing to reject speculative, high-risk capital that merely seeks to flip property or arbitrage regulatory differences. It is an acknowledgement that economic protectionism, taken too far, becomes a recipe for stagnation. To delve deeper into the long-term implications and the potential pitfalls of this aggressive policy shift, we are joined now by Dr. Marcus Shaw, Professor of International Economics at the prestigious Victoria University of Wellington. Dr. Shaw, thank you for being with us at this critical moment. Let's cut through the political rhetoric. Is this law truly the economic game changer the government claims, suggesting a sharp reversal of fortunes? Or are there significant underlying risks that the speed of its passage might have obscured? It is certainly a policy move of monumental significance, and I would argue it is a necessary and mature policy pivot, reflective of the current global economic reality. The data is clear. Historically, New Zealand's primary obstacle to attracting quality investment wasn't a lack of interest in its highly skilled workforce or its stable political environment. It was almost exclusively bureaucratic friction and uncertainty. Global capital is mobile and impatient. It has alternatives. If your regulatory process takes a year and requires multiple rounds of negotiation, while Australia's takes 3 months with clear parameters, you lose the bid, time and again. The fact that Wellington is now strategically prioritizing investments that deliver clear, measurable public benefit, such as technology transfer, R&D commitments, or guaranteed high-wage job creation in regional areas where opportunity is desperately needed, is fundamentally sound economic policy. It moves away from a blanket political no and shifts towards a strategic, conditional yes, but only if you meet our explicit national strategic needs. This targeted approach is intelligent. But let's pivot to the enduring domestic concerns, Doctor. We know this policy has generated significant friction. Critics argue that streamlining the approval process, regardless of the tiers, may inherently weaken regulatory vigilance. This could potentially drive up operational costs for smaller local businesses by attracting giant foreign competitors, or perhaps most critically, accelerate the foreign acquisition of residential land via complex commercial to residential conversions.
How robust, in your expert opinion, are the protections built into FIGA to prevent these deeply sensitive domestic impacts? That vigilance remains the single greatest concern, and the integrity of the enforcement mechanisms will ultimately define success. We must be clear. The law maintains extremely high, almost prohibitive hurdles for the direct foreign acquisition of existing residential property. Those core provisions, stemming from reforms enacted in 2018, were largely untouched by FIGA. Success depends entirely on the integrity and independence of the new regulatory enforcement team, particularly the staff administering the national interest test. This team requires robust, non-political funding and an absolute mandate for transparent execution. It is a necessary opportunity, yes, but success hinges entirely on disciplined, scrupulous execution and clear communication to the public that these investments are serving New Zealanders first. Without transparency, the trust in this fast-track mechanism will quickly erode. Discipline, transparency, and execution, the true conditions for success. Dr. Marcus Shaw, Professor of International Economics, thank you for providing that essential, sobering context. The passage of the Foreign Investment for Growth Act marks a definitive and powerful inflection point for New Zealand's economic strategy, signaling a pronounced pivot toward aggressive global engagement and away from internal regulatory caution. Wellington is actively inviting the world's capital, but demanding stringent conditions in return. A strategy that recognizes economic growth and sovereignty are not mutually exclusive, but interdependent. The challenge now shifts from legislative passage to operational reality. Can the Overseas Investment Office, a body historically geared toward rejection, transform itself rapidly enough to become a world-class facilitator of complex, high-value deals?
Can they attract sufficient regulatory expertise to police the national interest test without becoming overly cautious, thus defeating the purpose of the law? The world will be watching closely to see if this streamlined, strategic approach can deliver the substantial, sustained productivity boost and critical infrastructure upgrades that the nation desperately needs to secure its standard of living into the mid-21st century. New Zealand has made its high-stakes economic bet. The timer on accountability starts now. We will continue to follow the implementation of this landmark legislation, including the release of the final, crucial regulatory standards later this quarter, which will determine the fine print of this economic gamble. For continuous rolling updates on this story and deeper analysis of its implications for key sectors across the Asia-Pacific region, please visit our website and subscribe to our mobile alerts. That's all the time we have for tonight. I'm Anchor Name. Good evening.